Something just changed in crypto that most investors are completely misreading right now. Because what looked like a normal sell-off is now showing signs of structural stress across multiple layers of the market at the same time. This is where sentiment and system behavior start to diverge. In this video, you'll see what actually triggered the recent shock, how major crypto ecosystems are behaving under pressure, and why this phase looks less like volatility and more like a reset in how the entire sector is being priced and understood. What's happening right now is not isolated. It's not a single chart move, and it's not just sentiment flipping risk off. Multiple stress points have appeared across almost simultaneously different parts of the crypto ecosystem. One of the most important signals came from a privacy-focused crypto system experiencing a critical exploit that directly challenged one of the core assumptions of digital assets. Scarcity cannot be broken. But here's what makes this moment different. The market didn't just react to one failure. It started repricing trust across the entire structure. At the same time, institutional exposure models tied to Bitcoin accumulation strategies began showing stress in their financing mechanism. Not price stress first, structural stress. And that distinction matters. Because in previous cycles, price led the narrative. This time, the narrative is reacting to system-level fragility appearing underneath the surface. And when that happens, markets don't move smoothly. They reevaluate everything at once. Short-term chaos versus structural failure. In every financial cycle, there are two types of collapses: temporary volatility and structural breakdown. What we're seeing right now sits dangerously close to the second category. Because when multiple unrelated systems fail at once, privacy tokens, leveraged treasury models, speculative ecosystems, it stops being coincidence, it becomes correlation. But here's where most investors misread history. They assume all collapse means extinction. History says otherwise. Quick disclaimer, this content is for informational and educational and entertainment purposes only, not financial advice. With that said, let's continue. I want to talk about the South Sea bubble. In 1720, Britain experienced one of the earliest financial manias, the South Sea bubble. A single trading company promised massive returns from trade expansion across the South Seas. Investors poured in. Politicians endorsed it. Even Isaac Newton reportedly invested. But the reality was simple. The value narrative was stronger than the underlying economics. When confidence broke, the entire structure collapsed in months. Not because trade disappeared, but because expectations were detached from reality. Sound familiar? Because in crypto today, we've seen similar cycles. Narratives outrunning utility. Capital chasing stories instead of systems. But here's the critical distinction. After the collapse, global finance didn't disappear. It evolved. The Zcash exploit and the scarcity problem, ladies and gentlemen. The immediate catalyst in this narrative is a critical exploit in a privacy-focused cryptocurrency system that theoretically allowed token inflation beyond design supply constraints. And that is not a small technical bug. That's existential. Because crypto doesn't just rely on technology. It relies on trust and math. If issuance rules can be broken, then scarcity becomes optional. And if scarcity becomes optional, value becomes unstable. But here's where it gets interesting. This isn't just about one asset. It exposes a broader issue. Many digital assets rely more on perceived security than proven resilience. And when stress arrives, perception collapses faster than code can be patched. MicroStrategy structural leverage risk. See, at the same time, institutional crypto exposure models, particularly those tied to corporate Bitcoin accumulation strategies, are showing signs of strain. Some of these models depend on continuous market confidence to issue equity instruments that fund further accumulation. That works until it doesn't, because leverage works in both directions, upward in euphoria, downward in stress. But he's here where it gets interesting. This is not a crypto problem alone. It's a financial engineering problem, repeating across asset classes. We've seen this before in structured credit markets, mortgage-backed securities, and leverage ETF cycles. The instrument changes. The pattern does not. If you're enjoying breakdowns like this, make sure to like and subscribe to the channel. It helps us out a lot. Now, with that being said, let's continue because the next part is where it gets more important. I want to talk about the dot-com collapse in 2000. See, in the late 1990s, the internet was real, transformational even, but most companies built on it were not. When the dot-com bubble collapsed in 2000, thousands of companies vanished. Yet the internet did it. Amazon collapsed over 90% in value. So did many infrastructure plays. But the underlying technology survived and became the foundation of the modern economy. The lesson is simple. Crisis doesn't kill innovation. It removes excess narratives attached to it. And crypto might be entering that same phase. Ethereum and Solana, speculation versus utilization. See, when examining major blockchain ecosystems, a key divergence appears. Ethereum saw explosive decentralized finance activity in the early 2020s. Solana experienced similar momentum driven heavily by retail speculation cycles and token-driven engagement. But after peak hype phases, activity cooled. And this is important because it suggests that a portion of blockchain growth was not driven by sustainable economic demand, but the incentive cycles. But here's where it gets interesting. In every technological revolution, early adoption always includes speculation. Rails, internet, electricity. Speculation is not the problem. Sustainability is. In contrast to speculative cycles, some networks are being positioned around institutional settlement use cases. The idea is simple. Instead of focusing on consumer speculation, focus on back-end financial infrastructure. This is where systems like the XRP ledger are often positioned by proponents. A settlement layer designed for fast, low-cost financial transfer between institutions. And recent developments in tokenized real-world asset, regulatory clarity discussions, and institutional experimentation suggests a growing interest in blockchain settlement systems. But here's where it gets interesting. Even if this narrative is directionally correct, adoption in global finance is never linear. It's slow, political, and heavily compliance-driven. In the 19th century, the telegraph revolutionized communication. Messages that once took weeks now took minutes. But early telegraph companies struggled to monetize sustainably. The infrastructure was ahead of its economic model. Only when governments, railways, and financial institutions adopted it did the system become economically dominant. The lesson, infrastructure wins only when institutions integrate it, not when retail speculation drives it. Regulation is often misunderstood in crypto cycles. It is not simple restriction, it is selection. It determines which systems can survive integration into global finance. Assets with legal clarity and institutional compatibility tend to move differently in later stage cycles. But here's where it gets interesting. Regulation doesn't guarantee success. It only determines eligibility. Markets still decide. Think of the post-gold standard transition. When global economies moved away from the gold standard, currencies entered a new era. Initially, instability increased. But over time, the new financial systems emerged based on fiat coordination, central banking frameworks, and global liquidity flows. The transition period was chaotic, but enabled modern financial expansion. Crypto may be in a similar transitional phase, moving from experimental assets towards regulated financial infrastructure. Here's the price versus value divergence. One of the most important lessons in every financial cycle is this. Price reflects emotions. Value reflects utility. During crisis phases, this can disconnect sharply. Assets can fall dramatically even when long-term structural relevance increases. But here's where it gets interesting. These are often the moments that define long-term winners. Not because prices are low, but because perception becomes detached from underlying function. What comes next for crypto? We're likely entering a phase where weak narrative-driven projects fade, over-leveraged financial structures unwind, utility-driven infrastructure narratives strengthen. Institutional participation becomes more selective. This does not mean the collapse of the entire sector. It means refinement. But refinement is not peaceful. It's disruptive. The Amazon lesson post-crisis creation. See, Amazon is one of the clearest examples of post-crisis opportunity. After the dot-com crash, it was widely dismissed. Its valuation collapsed. Its model questioned. Yet it survived because its core infrastructure, logistics, cloud computing, retail integration was real. The takeaway is not that every fallen asset recovers. It's that the ones built on real utility eventually separate from speculation. Here's the final structural outlook. Crypto is no longer in its experimental phase. It's entering its consolidation phase. The market's beginning to distinguish between financial engineering, narrative-driven speculation, real infrastructure utility, and this separation is where long-term capital is usually allocated. But here's the critical point. These transitions are not immediate. They unfold over years, not weeks. What looks like collapse is often reclassification. Assets are being reevaluated based on real-world function rather than narrative strength. Some will survive that process, others will emerge stronger. And the hardest part for investors is not identifying the future. It's separating emotion from structure while it's still unfolding. Because in every major financial transition history, ladies and gentlemen, the biggest losses were not caused by wrong timing, but by misunderstanding what phase the system was entering. What we're witnessing is not just a crypto downturn. It's a structural reset of expectations, leverage, and narrative. And the next phase will not be defined by hype. It'll be defined by integration between digital systems and traditional finance, between speculation and infrastructure, and between perception and reality. The only question left is who recognizes this shift before the market does. If you found value in this breakdown, subscribe for more institutional grade financial analysis, because the goal is not to follow narratives. It's to understand the systems generating them, the liquidity flows, the infrastructure layers, and the institutional positioning sharing the next phase of global finance. The transformation is not coming. It's being built in real time. I always tell you, ladies and gentlemen, pay attention to what's quiet. Hope everyone's having a blessed day. I want to welcome all the new members of our Patreon, all the new members of the membership channel. Remember, if you want to learn how to trade, if you'd like to learn how to invest, do come and join the Crypto Public Desk monthly. One good tip from the pits can easily pay for your entire year subscription. If you want the deeper macro research and learn how to take advantage of all this, come and join over 570 active traders inside our Patreon, the Crypto Public Desk monthly. Ladies and gentlemen, the smart money is preparing for something most investors don't see. See, there's a disconnect happening in the market right now that should make every investor feel uncomfortable. Really. I'm going to be traveling for the next few days, but we're going to have some content for everybody. I got to go pay some visits and visit some family offices that were referred to us that are very happy with our performance. And we're going to be referred to more people. So with that being said, when you risk everything, ladies and gentlemen, and you're correct, the greatest satisfaction is looking at the smile on people's faces in person, not listening to them say something to you over the phone. Knowing what you said ex ante was correct when most of the world just front runs things. That's the difference. Being a financial mercenary, being a financial renegade is going against the train and going against the buck, because that's where the biggest alphas to be made. None of this is financial advice, it's just my own opinion, and it retains any capacity. That's how you don't get cut up like sushi. Because if you look at headlines, everything seems relatively normal. You see stocks fluctuating. Investors are debating inflation. Everybody's always talking about AI. It's nothing unusual. But when you start digging into institutional positioning, option markets, volatility pricing, earnings, expectations, bond markets, and sector flows, a completely different picture begins to emerge. What I'm seeing right now is not confidence. It's caution. It's not panic. It's not fear, but caution. It's the kind of caution that typically shows up before volatility, not after it. And that's why what I'm about to go over right now really matters. Because the biggest mistake investors will make is believing markets move because of news. I always told you death by 1,000 tweets, death by 1,000 headlines. But they don't move because of news. They don't. That's how you get cut up like sushi. See, markets move because of reality. When reality collides with expectations, that changes a lot of things. Right now, expectations are extremely high for certain things. Let's start with the first problem, inflation. Everybody knows CPI is important, but almost nobody understands why. The market doesn't really care about inflation because inflation exists. The market cares about inflation because inflation influences bond yields, and bond yields influence valuations. The entire growth stock trade is built on this relationship, ladies and gentlemen. Write that down, let that sink in. That's why institutional desks are paying so much attention to the latest inflation data. Current projections suggest headline inflation could move back above 4% year over year, while core inflation remains closer to 3%. More importantly, market participants are assigning meaningful probabilities to both bullish and bearish surprise scenarios. And here's what I'm paying attention to. See, the downside scenarios are larger than the upside scenarios. Think about that for a second. Marinate on that. When professional traders model possible outcomes, the punishment for hotter inflation appears larger than the reward for cooler inflation. That's not confidence, that's sensitivity. And sensitivity creates volatility. But inflation isn't actually the biggest story, ladies and gentlemen. The biggest story is hiding inside technology, specifically AI. Because despite all the headlines you've seen, despite all the discussions about bubbles, despite all the debates about valuation, AI remains the dominant force driving market behavior. Institutional commentary continues to describe the markets as divided into two camps, AI winners and AI losers. That's it. Nothing in between. And when a market becomes that concentrated around a single theme, every investor should really pay attention because a lot of people are going to get cut up like sushi. Not because concentration guarantees a crash, but because concentration magnifies every surprise. The question being asked behind closed doors is fascinating. Not is AI real? The debate is over. Question now is, how long can growth continue accelerating? Because expectations have reached extraordinary levels. The market isn't demanding growth anymore. It's demanding acceleration. And there are two things institutions are watching very closely. First, revenue growth from the major AI labs. Second, whether scaling laws continue producing meaningful improvements in model performance. Why does this matter? Because trillions of dollars in market value are being justified by the belief that bigger models, more compute, and larger infrastructure investments will continue generating superior outcomes. That thesis strengthens, AI stocks may continue dominating. If it weakens, even slightly, expectations could reset very quickly. That's here where things get really interesting and spicy, in my opinion. See, while retail investors argue online about whether AI is hype, institutional users are dramatically increasing usage, okay? Professional analysts are reportedly spending tens of thousands of dollars annually on AI tools, with some budget exceeding six figures. Think about what that means. These aren't influencers. These aren't hobbyists. These are people whose jobs depend on making accurate decisions. They're not talking about AI. They're using AI. That's a big difference. There's a massive, massive difference in these two things. See, usage is real. Adoption is measurable, ladies and gentlemen. Okay? Revenue follows adoption. That's why the smartest investors aren't asking whether AI matters. They're asking who ultimately captures the economic value. That leads to another overlooked trend. The next AI winners will not be the obvious names. Historically, the largest returns come when markets change their minds about a company. When a perceived loser becomes a winner. Several major technology companies are attempting exactly that transition right now. The challenge is proving that the massive AI spending can eventually translate into massive AI revenue. Until the proof arrives, investors remain skeptical. Once it arrives, the re-rating can happen very quickly. And that's exactly what institutions are monitoring. Let's talk about something, at least I find important, but nobody's discussing right now, positioning. Positioning often matters more than fundamentals in the short run. See, recent institutional commentary points to ongoing de-risk, elevated volatility, profit-taking across parts of technology, and increasing caution among investors. That doesn't mean investors are bearish. Doesn't. Write that down. In fact, many constructive over the mean term. They're very, very constructive, okay? But they're being selective. This is a critical distinction. Selective investors don't chase everything. They demand evidence, they demand execution, they demand results. And that creates a market where winners and losers separate very quickly. The days of everything going up together may be ending. The next phase could be very much more unforgiving. Companies that deliver will be rewarded. Companies that disappoint could be punished immediately. Which brings us to the biggest takeaway of all. The market's entering an environment where narratives are becoming less important than proof. See, for the last 2 decades, stories drove markets. AI stories, rate cut stories, economic stories. Now investors want evidence. Evidence of monetization, evidence of productivity, evidence of earnings growth, evidence of durable demand. And when markets transition from storytelling to proof, volatility increases because reality is messy. Reality doesn't move in straight lines. Reality disappoints people. The investors who understand this shift early tend to perform much better than those who realize it late. So as everyone watches headlines, social media, and television debates, pay attention to what institutions are actually watching. Inflation, bond yields, AI monetization, enterprise adoption, sector flows, positioning, because those are the variables quietly shaping the next major move. Right now, those signals suggest the market may be entering one of the most important decision points of the year. Not because the economy is collapsing, not because AI is ending, but because expectations have become so high that the reality finally has to catch up. Ladies and gentlemen, it's very amazing to watch how certain reports can change the entire dynamics of the market. Literally overnight. The most important thing always, even what Jesse Livermore had said, your position sizing. It's got to be small enough so it can be carried, cut, added to. You have to be able to outlast the market because the market will outlast you and punish you the moment that you violate the laws of the market. Understand one thing right now. Pain in the markets is temporary. It is. What's not is profits. Profits. I hit you guys and girls with a lot of information. I always do. When you make it to the end of the videos, and I got to answer everyone's comments from yesterday, I've just been on the phone so long. You have to realize something. I'm going over everything that's really, in our opinion, that's super important. That if you pay attention and you're actually writing these things down, you're further ahead than 99.9% of the market because you're hearing what institutions, family offices, and sovereigns hear directly. You're hearing the Cliff Notes version of it. If you want the rest, join the Crypto Public Desk monthly and take advantage of all that. See, here I lay out what we're watching. Inside, we lay out what we're playing and why and levels and price points. The summer is always very volatile. The moment that there's reasons for people to take action off the table, they do. And they'll come back when the summer's over. Kinetic action never stopped in the Middle East. That's flaring up again. Ladies and gentlemen, as always, this information is for educational, entertainment purposes. Never invest solely because of a YouTube video. I love you all. I'll see you on the front lines. Don't get cut up like sushi. Don't FOMO this. Follow your plan. That's it. On days like this, you just follow your plan. We're in the camp and the narrative of the Clarity Act has passed. A lot of things will switch back to a different tone and tempo in the markets. It's what you do in between that matters. With crypto, you got to be prepared for 50% drops. Bitcoin does that. Altcoins do even more. That's why I always preach XRP, ICP, HBAR. The utility of these coins is very important. I love you all. I'll see you on the front lines.